For years, the increases arrive in amounts that feel annoying but survivable. A few extra $100 here, a new fee there, a parking spot that used to be included now, split out as its own line item. In cities like Los Angeles, San Francisco, San Diego, and Sacramento, that slow creep quietly accelerated until the ratio between income and housing stopped looking like tight but manageable and started looking like mathematically impossible. Daniel and Stephanie did not sit down one night and suddenly discover a crisis. They watched the same pattern repeat itself lease after lease. The only difference by the end was that the numbers finally got loud enough that they could not pretend it was normal anymore. For Daniel, the breaking point looked deceptively simple on screen. Just two numbers sitting side by side in a spreadsheet. On one side, his monthly take-home pay after federal and state taxes, the amount that actually hit his account and paid for his life. On the other, the rent for his one bedroom in the Mission, a number that had pushed into the mid-3,000s while everything else in his life tried to keep up. When he first moved to San Francisco, that rent had landed at a little over a third of his take-home pay. High, but in the range everyone told him was standard for the city. Years later, renewal after renewal, that ratio had climbed into the 40s and then nudged toward half, a level that would have sounded insane if he had said it out loud in any other part of the country. What changed was not just the rent itself. It was the realization that every raise he celebrated had been quietly absorbed by his landlord and by Sacramento before it could ever touch his actual life. Stephanie's version of the same story played out over a larger floor plan, but with the same underlying math grinding away in the background. Her 3-bedroom in Culver City felt like a victory when she first signed the lease, a place that her kids could remember as their childhood home, close enough to decent schools and her office to make the commute tolerable. The rent was steep from day one, but it rode just under the threshold where she felt reckless, a bit over 40% of her take-home pay when she added it all up with a pen on yellow paper. The problem was that her income moved in careful, negotiated steps, while the rent moved like it had somewhere else to be. By the time her kids were old enough to ask why they did not have a yard, renewals had pushed her monthly payment well past that 40% mark, or into a zone where every new school expense felt like a minor emergency. The rent check left her account each month with the same regularity as the sunrise, and the space it consumed in her budget left little room for anything else to grow. In both of their lives, the rent number did something subtle but powerful to the rest of the equation that governed their days. Savings became whatever was left over instead of a line item they could protect, something they promised to get serious about next year once the current wave of expenses passed. Travel shrank to short trips and long weekends because flights and hotels had to compete with the non-negotiable reality of housing, and housing always won. Even basic upgrades, a newer car, a home office setup that did not double as a kitchen table, kept getting pushed into a vague future where things would be easier, but never quite arrived. When almost half of your take-home pay goes to the roof over your head in a place where you do not own the door you are locking every night, the future starts to feel less like a plan and more like a rumor. You are not building toward anything. You are maintaining access to a zip code. The strangest part, for both of them, was how normalized this had become in their circles of friends and colleagues. In San Francisco, Daniel could say that his rent was approaching half his take-home over drinks, and get nods, not shock, because everyone around him was running some version of the same math. In Los Angeles, Stephanie could talk about a $4,000 rent for a decent 3-bedroom and still feel like she was on the modest side of local horror stories that pushed into the fives. That normalization is part of what kept them anchored for so long, because if everyone around you is paying similar numbers, it is easy to treat the situation as inevitable rather than optional. The market starts to feel like weather, something you endure, not something you can step out of by crossing a state line. It becomes an identity, not a transaction. The illusion began to crack the first time each of them compared their local ratios to housing in other cities using the exact same salary. Daniel punched his current income into calculators for Austin and Phoenix and watched the rent share of his take-home drop out of the 40s and into the 20s on screen, even while assuming a nice apartment in a central neighborhood near coffee shops and co-working spaces. The shift was not just a few $100s a month. It was the difference between saving aggressively and treading water while hoping for a bonus. Stephanie ran a similar experiment for suburbs outside Dallas and Raleigh, plugging in a realistic mortgage payment for a modest house in a good school district with actual trees and a backyard. The result looked almost like a mistake. A housing cost that took up a smaller slice of her pay while delivering something she had mentally filed under maybe in another life. A yard, a spare room, a sense that her payments were building equity instead of feeding a landlord. This is where the rent story stops being about abstract cost of living charts and starts becoming a quiet referendum on what a life is worth. When Daniel modeled his budget as a renter in San Francisco 5 years from now, assuming the same pace of increases his landlord had already followed, the future line items felt suffocating, even before he filled in the details. The proportion of his income eaten by housing left barely enough oxygen for investment, for starting a company, for taking any meaningful risk beyond another promotion in the same industry. When he modeled the same 5 years as a renter first, and then a buyer in a lower-cost city, his housing number shrank to a size that left room for compounding to do its work and for mistakes that would not be fatal. Stephanie's version of this future felt even more urgent because her timeline included her kids aging into and out of school systems that were already stretched. Staying in Los Angeles meant betting that somehow, against the evidence, she would leap from renting to owning in a market where even tired starter homes were galloping away from her savings rate. At a certain point, the rent line on their charts stopped being just a number and started feeling like a verdict on their choices. It was saying clearly that in California they could either live well today or build stability for tomorrow, but not both at the same time on their current incomes. Every month they chose to renew was a month they implicitly chose present convenience and identity over future control. And for a long time, that trade felt worth it because the career opportunities, the culture, and the version of themselves they had built in these cities felt irreplaceable. The more they looked at alternate cities, though, the less that uniqueness held up under scrutiny. It turned out that a lot of what they loved about their current lives could travel with them. While the rent burden stayed behind like a toll booth, they no longer had to drive through. What makes the rent line a true point of no return is that once you have seen the contrast in black and white, it will not unsee itself. Daniel could not go back to thinking of his San Francisco lease as simply the cost of living in a great city, after watching his housing share cut nearly in half, in an Austin or Raleigh scenario that did not require a pay cut. Stephanie could not unlearn that in some markets, a solid professional income still buys a house in a good district without swallowing half the household cash flow and every ounce of mental bandwidth. The decision to leave does not happen instantly, but the moment of mental break happens quickly. It is the instant when rent stops being just expensive and becomes the main reason you cannot hit any of the other goals you care about, the line item that quietly vetoes every other plan. For the millions of people whose stories will never be written up in glossy think pieces, this is what the exodus looks like at the ground level. It is not a dramatic slam of the door or a single headline about a company decamping to Texas. It is a slow, grinding recognition that the housing market has shifted from challenging to hostile for anyone who did not buy early. Once enough households cross that threshold, the statistics start to move in ways that finally catch the attention of analysts and policymakers staring at population charts. But by then, Daniel's spreadsheet and Stephanie's yellow highlighter have already done their work in silence. The decision is no longer about whether California is beautiful or interesting or special. Everyone knows that it is. It is about whether the rent a person pays every month is buying them a life that moves forward or a life that stands still, and what they are willing to do once they realize which side of that line they are on. If rent is the monthly pressure you feel every 30 days, home ownership in California is the promise that keeps moving just out of reach. For Daniel and Stephanie, buying a place was never about granite countertops or open floor plans. It was about landing somewhere solid after years of feeling like tenants in their own lives. On paper, they were exactly the kind of people the American home ownership story was supposed to reward: professionals with good incomes, no catastrophic debt, and a track record of paying on time. In another state, that combination would have translated into a starter home in a decent neighborhood before mid-career. In California, that same combination dropped them into a system that quietly splits residents into two groups living side by side under completely different rules. To understand why, you have to picture a single house on a quiet street in the suburbs outside Los Angeles or San Francisco. On one side of the property line is a retired couple who bought the place 3 decades ago, back when prices were high for their time, but still tethered to local incomes. On the other side is a younger buyer trying to purchase an almost identical house this year with a fat down payment that took a decade to save. Thanks to a property tax structure that locks in low assessments for long-time owners, the retired couple pays something like $4,000 a year in taxes on their place. The new buyer for the same square footage, on the same street, is staring at a bill closer to $12,000 a year. The street looks like a single neighborhood, but the tax code has quietly turned it into 2 different Californias. Daniel discovered this gap the way most modern professionals do, not through a policy paper, but through a mortgage calculator and a property tax estimate buried 3 clicks deep on a county website. He had run the numbers on a modest condo in a not quite trendy San Francisco neighborhood, something smaller and older than the apartments he had rented, but his own. The principal and interest payment were painful, but just within the realm of possibility if he stretched, cut back, and assumed the next promotion would arrive on schedule. Then he plugged in the projected property tax and watched the monthly total jump by an amount that made his throat go dry. The tax alone was higher than his parents' entire first mortgage payment back in their Midwestern city, and that was before utilities, insurance, and the inevitable special assessments that come with shared buildings. Stephanie's encounter with the 2 Californias came at an open house in a neighborhood she had been eyeing for years, the kind of place with tree-lined streets and crowded elementary school parking lots at pickup time. The house itself was fine, not spectacular, a 3-bedroom with a small yard and a kitchen that still carried the ghost of the 1990s. What caught her attention was the property tax line on a printout the agent had left by the door, a number that seemed almost reasonable for the area. When she asked, the agent explained that it reflected the current owner's locked-in assessment from decades ago, and that any new buyer should expect a much higher bill. In that moment, she understood that the dream she was walking through had been priced for another generation, and that the version available to her would cost thousands more each year for the same cracked driveway and aging roof. This is the quiet genius and cruelty of the system for anyone arriving late to the party. Long-term owners in California are shielded from the full force of rising values, their taxes anchored to the price they paid back when the numbers were smaller and the stakes felt lower. For them, the state's explosive growth in housing costs looks and feels like a win, a paper gain that does not crush their cash flow. For new buyers like Daniel and Stephanie, the same protection acts like a wall. They are not just competing with other hopeful purchasers for limited inventory, they are competing against a tax structure that effectively subsidizes the people who got in early and charges full freight to the people pulling up now. The benefit is not evenly distributed. It flows toward older, longer-rooted, they're often wealthier households and away from newcomers trying to build their first foothold. When you lay this on top of already high sticker prices, home ownership stops being a stretch goal and starts looking like a rigged game. Daniel did the back-of-the-envelope math on what it would take to buy even a small house within commuting distance of tech offices he no longer had to visit in person. The down payment alone, 20% of a 7-figure listing, was a number that would eat almost all of his savings and still leave him with a massive monthly obligation. Add in property taxes several times higher than what the longtime owner next door paid for the same services, and the prospect shifted from exciting to absurd. The risk was not just that he would feel house poor for a few years. It was that one job change or one bad stock grant year could turn his dream purchase into a very expensive trap. Stephanie approached the question with a family lens, charting not just her current income, but the window of time left before her kids would be out of the house. To make buying in a decent Los Angeles school district work on paper, She had to assume steady raises, low interest rates, and almost no big surprises, an optimistic blend of conditions that reality rarely respects. Even in the best case, the combination of mortgage and property tax would push her housing burden into a place where there was no slack left in the system. Vacations, college savings, even basic home maintenance would have to fight for the scraps left over after the state and the lender took their dues. When she compared that scenario to a similar house near Raleigh or Dallas, she saw not just lower prices but a property tax bill that did not punish her for arriving late. The term ownership itself becomes slippery in this environment, because not all owners are living the same story. The neighbor paying $4,000 a year in taxes on a house, now worth many times that amount, can treat their place as a stable, almost passive asset. Their cost base is frozen in a different era, and as long as they stay put, they ride the upside with limited downside pressure. The new buyer down the block is effectively renting from the bank and the county at the same time, paying a premium for the privilege of joining a club that once admitted middle-class families as a matter of course. On paper, they both carry the title homeowner, but their monthly realities belong to different economic planets. For renters looking in from the outside, this split explains why the latter feels like it has missing rungs. Daniel could save diligently for years and still watch the target move faster than his ability to catch it, because each uptick in prices resets the bar for how much the county expects from him in taxes. Stephanie could cut every discretionary expense and still find that the carry costs of a modest California home consume so much of her income that the rest of her life has to shrink to accommodate it. In other states, the jump from renting to owning changes the shape of a budget, but does not obliterate it. In California, the combination of high prices and an uneven tax structure can make that jump feel less like climbing a staircase and more like trying to clear a canyon. Once Daniel and Stephanie started comparing this dynamic to what ownership looked like in Texas, Arizona, Nevada, and North Carolina, the differences were stark enough to feel almost unfair. They saw markets where property taxes could still be high, but were at least applied consistently to new and old owners, where the neighbor across the street was not paying a fraction of their bill for the same schools and roads. They saw price points where a professional income actually bought a house without requiring heroic levels of sacrifice just to keep the lights on. The more they looked, the more it became clear that staying in California meant accepting their place in the second California, the tier built on latecomer rules. Leaving held out the possibility of joining a market where they were not always arriving after the door had quietly half closed. In the end, home ownership was never just a financial goal for them. It was a story about belonging and security. California still offers that story to people who locked in early, who bought when prices were high but not yet unhinged, and whose property tax assessments now read like inside jokes from a cheaper century. For everyone else, the legend feels increasingly hollow. You can walk through neighborhoods that look like a shared dream and know that behind the identical facades, two entirely different sets of numbers are at work. For Daniel and Stephanie, seeing that split in such clear relief was another piece of the equation clicking into place. The question stopped being whether they could someday buy in California and became whether it made any sense to keep trying under rules designed for someone else's timeline. By the time you finish adding up the obvious costs of living in California, there is a second layer waiting underneath, quiet but relentless. Rent and mortgage get all the attention because they are big, round numbers that hit once a month like a punch, but they are not alone in the ring. State income tax, utility bills, and homeowners insurance do their work in the background, shaving off chunks of every paycheck before you even notice they are missing. Daniel and Stephanie both felt this as a kind of ambient pressure, a sense that their money evaporated faster in California than it would anywhere else. It was only when they started isolating each piece of the stack that they saw how much of their life was being siphoned away by costs they never see on a real estate listing. Start with state income tax, the quiet partner in every raise, bonus, and stock grant that passes through a California paycheck. Daniel remembers the first time he compared his net pay to a friend in Texas with a similar salary, staring at the difference in their take-home as if there had been a mistake in the system. The gross numbers looked almost identical, but Daniel watched thousands of dollars a year peel off into state coffers, while his friend kept more of what he earned. At lower incomes, that bite is annoying. At six-figure professional levels, it becomes a structural difference in how fast you can build savings or pay down debt. Stephanie saw the same pattern when she ran her annual numbers through online calculators, realizing that even before she paid for housing, schools, or groceries, California was pulling harder on the rope than many of the places she was researching. On its own, that higher tax might be justifiable if everything else in the budget sat at reasonable levels, but California piles expensive on top of expensive. Utility bills are a perfect example, the kind of line item most people treat as background noise until the totals climb high enough to demand attention. In Daniel's mission apartment, electricity and gas were not just an afterthought, they were another three-digit payment, stacked on top of an already swollen rent. Every hot shower, every winter heater cycle, every hour his laptop stayed open to work late into the night carried a premium he would not be paying in Nevada or North Carolina. Stephanie's experience as a renter in Los Angeles was similar, with summer air conditioning turning from comfort into something that had to be rationed. Not because of moral virtue, but because of the bill that arrived like a second rent for the privilege of not sweating through the evening. Then there is homeowners insurance, a cost that sits in the future like a storm cloud for people who do not yet own but hope to. In a state where wildfire seasons blur together and insurers quietly pull back from entire regions, premiums have been climbing like hikers on a steep trail. When Daniel first plugged sample insurance quotes into his ownership spreadsheets for a hypothetical house somewhere on the fringes of the Bay Area, the numbers felt disconnected from reality, as if they belonged to oceanfront mansions and not modest, aging homes on hillsides. The idea that you could buy into the California dream and still not be sure your insurer would stick around after the next major fire season added a psychological cost on top of the financial one. Stephanie, looking at family-sized houses in the inland suburbs, saw the same story written in different digits, with annual premiums large enough to tip a barely viable budget into the red. What makes this trio so dangerous is not any one bill, but the way they compound each other over time. Daniel's pay stub is a small case study in stacked friction, with state tax clipping the top, utilities gnawing at the middle, and insurance numbers looming over any future plan to buy. If he stayed in California, each raise would be filtered through this system before it reached his account, a series of toll booths that made every mile of progress more expensive than it needed to be. Stephanie's household budget told a similar story, with a high marginal tax rate eroding the benefit of extra hours and promotions, utility costs squeezing the everyday, and theoretical insurance premiums turning the idea of owning in certain zip codes into something closer to a luxury bet. The result was a feeling that their effort and intelligence were being poured into a leaky container, one that could never quite fill no matter how much they earned. The contrast became painful once they started running parallel universes of their lives in other states using the same salaries. Daniel modeled his current income in Dallas, Phoenix, and Raleigh, swapping California's state tax for lower or non-existent ones, and adjusting utilities and insurance to match typical local figures. Suddenly, his take-home pay felt like a different salary entirely, not because his employer had changed anything, but because the government and service providers were taking smaller bites. The discretionary line in his Texas or Arizona scenarios actually deserved the name. There was money left for investing, for travel, for risk. Stephanie ran similar side-by-side comparisons for family budgets in Nevada and North Carolina, discovering that the difference in annual leftover cash was large enough to fully fund college accounts or pay off a mortgage faster without any change in her professional title. The hidden stack also reshaped how they thought about risk and resilience. In California, an unexpected expense did not have to be catastrophic to feel destabilizing. A car repair, a medical bill, or a short gap between jobs all landed harder because the fixed costs were already so heavy. Daniel realized that losing even a single month of income would set him back much further in San Francisco than it would if he were paying less in tax, less for power, and less to insure a home somewhere else. Stephanie imagined what would happen if her company reorganized or shifted her role, forcing a temporary pay cut or move, and could not shake the sense that California gave her less room to absorb shocks. In states with lower ongoing burdens, those same events looked survivable, frustrating but not life-altering. There is also a psychological toll to seeing such a large share of your effort vanish into systems that do not feel responsive. Californians can tell themselves that higher state taxes buy better services, that higher utility rates reflect environmental policy and infrastructure, that higher insurance premiums are the price of living in a beautiful but risky place. For some people in certain neighborhoods, pieces of that story hold true. For Daniel and Stephanie, stuck in districts with crowded schools and aging roads, the promised return on their contributions did not match what they saw every day. Paying more might be easier to swallow if it clearly bought something better. In paying more for outcomes that still felt strained, made the decision to subsidize the state with their careers feel less like civic duty and more like voluntary self-harm. Once you see the hidden stack, it is hard not to redraw the map of which cities actually make sense for your life. Daniel began to think less about whether he loved coffee shops in the Mission, and more about whether those lattes were worth handing over so much of his income to a tax and utility regime that would never know his name. Stephanie, who once saw Los Angeles as the only place she could balance career and family, now saw rival options in Texas, Arizona, Nevada, and North Carolina that asked far less of her wallet for comparable or better daily experiences. The equation shifted from an emotional question, "Do I love it here?" to a sharper one, "Does this place love me back in proportion to what it takes?" In that new frame, California's charm started to look like an expensive habit she could no longer justify. For the people who ultimately joined the 2 million who left, this hidden stack was often the final weight on the scale. Rent and home prices pushed them to the edge, but taxes, utilities, and insurance made the edge feel crowded and unstable. A different combination of those same variables in another state offered not just lower monthly bills, but a sense that the math of their lives would once again line up with common sense. Daniel and Stephanie were not chasing some fantasy of perfect safety or zero taxes. They were looking for a place where the basic operating costs of being a responsible adult did not consume all the upside of doing well. Once they realized that such places still existed, and that they could reach them by trading California's hidden stack for a cleaner equation elsewhere, in staying started to look less like loyalty and more like denial. If the money was the only variable, the decision would be cold and simple, but life does not work that way. For people like Stephanie, the spreadsheet is always sharing space with something messier and harder to quantify: the question of what kind of childhood her kids will remember. Every school drop-off, every walk from the car to the classroom is an input into that equation just as real as rent or taxes. She knows the rankings of her local public schools the way other people know sports stats, can recite test score averages and student-teacher ratios while packing lunches. When she compares those numbers to the housing costs wrapped around them, the mismatch is sharp, like paying first-class prices for a seat in the back of the plane. On paper, her Los Angeles district looks acceptable, not a disaster, but not exceptional either, a sea of average scores with pockets of overcrowding and stories about burned-out teachers. The nicer neighborhoods with truly elite public schools are protected behind price tags that might as well be velvet ropes, with median home values that laugh at her income. Private school is technically an option, but only if she is willing to treat tuition as a second mortgage layered on top of the rent she already struggles to justify. In that reality, her kids' education becomes a function of how far she can stretch an already overtaxed budget, not of how much she cares. When she looks at reports from school districts in North Carolina or Texas, where solid ratings come bundled with homes inside her reach, it feels less like temptation and more like an indictment of the trade she is making by staying. Safety sits beside schooling in the mental ledger, not always explicit, but always present. Over the years, Stephanie has built a mental map of which blocks she avoids after dark, which parks feel fine on a Saturday morning but less inviting at dusk, Which freeway exits? She tells her kids never to linger near if they are out with friends later in life. None of this adds a line item to her budget, but it adds a constant low-grade vigilance that she can feel in her shoulders at the end of the day. Friends and family outside the state might fixate on crime headlines, but for her it is more subtle than that. A background soundtrack of car break-ins, porch thefts, and the occasional story that makes her check the locks twice before bed. When she runs scenarios in quieter suburbs in Nevada or North Carolina, she is not chasing some fantasy of zero risk. She is just wondering what it would feel like to live in a place where danger is not part of the daily ambience. For Daniel, schools and safety are less immediate but still part of the picture, because they speak to a broader question about social fabric. He walks through neighborhoods in San Francisco where the contrast between extreme wealth and visible hardship is no longer surprising. It is simply the backdrop. On some streets, new luxury condos share sidewalks with tents, and the city feels like two realities overlapped but never fully touching. That split seeps into how he thinks about future kids, future routines, future versions of himself jogging in the early morning light. In a different city, he suspects, those questions would revolve more around personal preference and less around managing around cracks in the civic infrastructure. So why does anyone stay, given the math and the strain? The answer is that California still works brilliantly for a specific set of people, and those people are not leaving in large numbers. Longtime homeowners protected by low property tax assessments have captured the upside of decades of appreciation without absorbing the full cost, and they see their neighborhoods through that lens. For them, the schools seem fine, the taxes seem fair, the utility bills are just part of the scenery because their housing costs locked in during a different era. Highly compensated coastal professionals in industries still anchored to California also find ways to make the equation work, especially if their paychecks sit at levels where even heavy burdens leave plenty of cushion. For that cohort, the state is not an exodus zone. It is still the center of the universe. There is another group who stays, not because the math is favorable, but because leaving asks too much of their identity. Daniel has friends who cannot imagine themselves in any zip code without fog, hills, and endless restaurants, who define themselves as San Franciscans as much as they define themselves by their careers. The idea of swapping that for a quieter life in Texas or North Carolina feels to them like stepping into someone else's story. They are willing to accept higher rents, slower savings, and crowded streets as the cost of preserving a version of themselves they worked hard to build. When Daniel looks at them, he understands it, because a part of him feels exactly the same way. For families like Stephanie's, the choice to stay is often laced with fear of regret on both sides. If she leaves, she worries her kids will miss out on some intangible benefit of growing up in a big, diverse coastal city, surrounded by culture and opportunity, even if the schools are strained. If she stays, she worries that she is trading away financial stability, home ownership, and smaller classroom sizes for a vibe her kids may not even value once they are older. That is the insomnia math, the kind that wakes her up at 2 a.m, wondering if she is steering them toward or away from the kind of life she wanted for herself at their age. The hardest part is that there is no control group, no parallel version of her family, living out the alternate decision to compare against. In the background of all this, California continues to sort itself economically and demographically. The people best insulated from the state's financial pressures become the ones most likely to shape its politics and culture, reinforcing a status quo that works for them. Meanwhile, the Daniels and Stephanies, who strain to make the numbers work, either leave quietly or adapt by lowering their expectations for ownership and savings. Over time, that process creates a state where the extremes deepen, with a larger share of long-time owners and very high earners anchoring the population in the most desirable coastal zones. The middle that used to fill in the gaps between those groups thins out, not because they stopped loving the state, but because the state stopped loving their balance sheets. When you zoom in on individual households, the decision to stay does not look like a clean economic calculation. It looks like a compromise. A young founder might stay in San Diego because their network and investors are there. accepting a lower personal burn rate for the sake of proximity to capital and talent. A teacher with a deep community in Sacramento might refuse to leave even as their peers scatter, because the value of continuity in their students' lives outweighs the stress of high rents. An artist in Los Angeles might choose a precarious existence over a quieter, cheaper city because the creative ecosystem there feeds their work in a way no spreadsheet can capture. These are not irrational choices. They are weighted decisions in which money is heavy but not absolute. For Daniel and Stephanie, watching who stays and who goes becomes its own kind of data. When their most financially sophisticated friends begin to talk openly about leaving, the signal is strong, because those are the people who usually see trends early. When the older neighbors with locked-in low taxes talk about staying put until the end, that also tells a story, one in which the benefits of the old California are increasingly reserved for those already inside the gate. The mix of departures and holdouts paints a picture of a state that still offers something extraordinary, but only at a price that many of the next generation's professionals and families can no longer justify. The question hovering over their decisions is simple, even if the feelings around it are not. In the end, schools and safety act like mirrors for the deeper financial math rather than exceptions to it. Good public schools in California often sit in neighborhoods where the entry ticket has climbed beyond what upper-middle-class incomes can comfortably pay, and safer, calmer streets frequently overlap with the same zones. That means the families most in need of those environments are often the least able to access them without absurd stretches or risky debt. In other states, the cost of buying into a good district still hurts, but it does not break people like Daniel and Stephanie on the wheel. As they weigh their choices, it becomes clear that staying in California means accepting a version of the state that does not match the one in the stories they grew up hearing, a version defined as much by who is missing as by who remains. When 2 million people move, they do not just disappear from one map, they redraw another. The story of California's exodus is not only about what pushed people out, it is also about what pulled them in elsewhere. Every truck that crossed the desert or flew over the Rockies carried not just furniture but income, skills, and demand that landed in new cities like a quiet economic shockwave. The question for Daniel and Stephanie was never simply whether to leave. It was where the math lined up in a way that felt like progress and not retreat. The answer, for a huge share of Californians, clustered around a handful of states that suddenly found themselves on the receiving end of a West Coast rebalancing. Texas stands at the center of that new map, not as a vague idea, but as a set of concrete city names that show up again and again in relocation stories. Austin, Dallas, Houston, and San Antonio each offer slightly different blends of jobs, housing, and culture, but they share one critical trait for former Californians: the ability to make a six-figure coastal salary feel like it actually belongs to the person earning it. When Daniel ran his numbers against Austin rents and suburban Dallas mortgages, he saw his housing burden fall to levels that would have felt like fiction back in San Francisco. A salary that left him feeling median and squeezed on the bay suddenly placed him near the top of local income distributions in parts of Texas, with cost structures built for lower baselines. For the state, each incoming Californian is not just a new resident, but a walking infusion of purchasing power. Arizona absorbs a different flavor of California refugee, people drawn more to a desert pace and suburban calm than to the big city energy of Texas. Phoenix and its surrounding suburbs show up repeatedly in Daniel's late-night searches and in Stephanie's family-focused research, offering single-family homes with backyards, newer construction, and a level of sun that makes California's coastal fog look like a different planet. The trade here is clear. You swap coastal scenery and ocean air for wide skies, sprawling freeways, and neighborhoods built with cars in mind. For many former Californians, that trade makes sense when the mortgage numbers come in thousands lower and the property tax bills do not punish them for arriving late. What Arizona gains is not just population, but a steady inflow of residents who are used to paying more for less and are pleasantly surprised to reverse that ratio. Nevada sits in the same constellation, especially around Las Vegas and Reno, where California plates lining apartment garages and new subdivisions have become a familiar sight. For Daniel, the draw of Nevada is the combination of no state income tax and relative proximity to the coast, a place where he can still fly back to San Francisco for a long weekend without treating it like a major expedition. Stephanie sees a slightly different appeal, the idea that she could own a home in a neighborhood with decent schools while still having access to a major airport, entertainment, and enough urban amenities to keep her kids from feeling exiled. The housing stock may not carry the same prestige as a leafy coastal street, but the balance sheets of families who move there tell a different prestige story, one measured in savings rates and shorter paths to ownership. Nevada's gain is a class of residents for whom the word affordable has become aspirational rather than literal. Then there is North Carolina, the quiet overachiever in this migration narrative, particularly in cities like Raleigh, Durham, and Charlotte. On paper, these places look almost too good to be true for someone fleeing California's math, strong job markets, rising tech and healthcare sectors, relatively sane housing costs, and public schools that routinely outrank what Stephanie can access without impossible housing payments. When Daniel drops his income into a Raleigh cost of living calculator, the numbers suggest a life where he can both live decently and build wealth without feeling like he is sacrificing every bit of cultural and professional stimulation. For Stephanie, North Carolina represents something even more specific: the chance to put her kids in solid public schools while owning a home on a lot with trees and grass, without tying a financial noose around her future. The state gains residents who are not just looking for cheaper rent, but for a full stack of metrics that beat what they left behind. What all of these destinations share is not perfection, but a different balance point in the equation that pushed people out of California. Housing costs still exist, taxes still exist, utilities and insurance still exist, but they do not conspire at the same levels and at the same time the way they did on the West Coast. In Texas and Arizona, Daniel sees rent and mortgage payments that land at a third of his take-home pay instead of half, giving him room to breathe and to invest. In Nevada and North Carolina, Stephanie sees scenarios where a single income can support a mortgage, reasonable schools, and occasional travel without triggering panic every time an unexpected bill arrives. The cities that win California's outflow are the ones that can offer a credible story where middle and upper middle income work still buys advancement, not just survival. From the perspective of those cities, the influx of Californians is both an opportunity and a stress test. Texas gets an injection of high-earning professionals and ambitious founders who bring coastal expectations about amenities, culture, and services, pushing local markets to evolve. Arizona and Nevada see increased demand that can strain their own housing supplies if they are not careful, risking a smaller version of the same affordability crunch that drove people out of California in the first place. North Carolina faces questions about how quickly it wants to grow and what kind of identity it wants to maintain as more remote workers and relocated families arrive. The winners of the exodus are not static beneficiaries. They are players in a new game where managing growth wisely will determine whether their current advantage lasts. For Daniel, the final equation crystallizes one night when he lines up 3 columns on his screen: California, his top Texas option, and his favorite North Carolina scenario. In each column, he lists his expected net income, his housing costs, his taxes, his utilities, his insurance, and his discretionary and savings capacity. The California column looks glamorous on the income line and brutal everywhere else, a tall figure at the top, eroded by a cascade of obligations below. The Texas and North Carolina columns look almost modest at the top, but strong at the bottom, with lower costs, leaving more actual life left over at the end of every month. For the first time, he feels like the numbers are not just interesting, they are issuing a verdict and an instruction. Stephanie does her own version of this exercise with a pen instead of a spreadsheet, listing California, Nevada, and North Carolina in 3 neat stacks on a blank page. Under each, she writes not just the financial numbers, but the human consequences: school quality, commute times, crime rates, housing size, how close her kids would be to extended family, how often she could realistically fly back to Los Angeles. The California column has undeniable strengths in culture, weather, and familiarity, but they sit beside housing payments and school trade-offs that make her chest tighten. The other columns do not offer the same glamour, but they offer something she has not felt in years, the sense that her effort could translate into upward motion instead of constant strain. The page in front of her does not make the decision for her, but it makes it impossible to pretend that staying is a neutral default. When you strip away the noise, what remains is a simple pattern. People left California in those 3 years, when 7 financial variables crossed their breaking points at the same time, and they went to places where those same variables still sat on the safe side of the line. Rent, home prices, property taxes, income taxes, school quality costs, utilities, and insurance all told one story in Los Angeles, San Francisco, San Diego, and Sacramento, and a very different one in Dallas, Phoenix, Las Vegas, Raleigh, and Charlotte. The winners of the exodus were not the cities with the best marketing campaigns. They were the ones whose spreadsheets returned answers that felt sane to people who were done gaslighting themselves about what they could afford. In that light, the movement of 2 million people stops looking like a mystery and starts looking like rational behavior. The final equation for anyone watching, including you, is not abstract. It is the sum of your income, your fixed costs, your risks, and your priorities weighed against the life you want 10 or 20 years from now. California still makes sense for some, especially those who locked in early or earn at levels where the burdens are heavy but not decisive. For many others, the math has already handed down its verdict. They are just waiting for the courage to listen. Daniel and Stephanie reached the point where their fear of changing states was finally smaller than their fear of waking up in a decade and realizing the numbers had stolen their options. The question is not whether you love where you live today, it is whether, when you run your own equation to the end, that place still loves you back enough to stay.